Hello, I'm Peter Towers, Managing Director and founder of ESS BIZTOOLS. Welcome to Accountants Minute Podcast. We're continuing with the series which we started last week on the innovation journey. And we're going to trace some post-research and development activities that are very important as part of the innovation journey. I believe this is real accountants' work to assist clients to, first of all, undertake the research and development and claim the research and development tax offset, as long as they meet their eligibility requirements, and then to really assist them on the commercialization process, because that's very important. So today we're going to be starting with the predictive accounting reports. You'll recall that last week we finished on the business plan. The predictive accounting reports are the financial interpretation of the business plan. It's no use having a business plan that's got no connection to the budgets, cash flow forecasts, projected balance sheets, and the all-important key indicators. So let's just go through some of this. This enables you to alert your clients to all sorts of things, to be the early warning radar about potential problems. Because if the predictive accounting reports, the budgets, the key drivers, the cash flow forecast, the projected balance sheet are based on the business plan, variations should mean that the business plan is not going to be achieved. So it's your early warning radar. Things are going wrong. And I think it is the foundations of a true virtual CFO service. And most definitely SMEs need this type of service delivered to them. And there's no excuse with today's technology, today's software, today's communications to be able to offer a more rounded service to SMEs. So the core of predictive accounting is budgets for each individual operation, not a consolidated budget, please. I've seen the horror that can cause, because all you need is to have one activity that's not performing to expectations, and it can throw the whole organisation out. But it can be difficult to isolate where the problem is if everything's just been thrown into one profit and loss account. So please, if your client's got 3 operations, it's 3 P&L accounts and 3 budgets. If it's 20, like very nearly the organisation that I had to work on for weeks trying to sort out what went wrong, to pinpoint why a well-performing, profitable company suddenly was off the rails. And we found it was human error. People hadn't communicated properly, although they thought they had, but the message hadn't gone through to the correct person who could have made the change. Basically, the change was getting back onto the client and saying to them, we've now had to change the route. This was a transport company that we take to deliver these products to your factory, because of the main roads department ruling a bridge out, and we've got to make an enormous detour on our journey, and we're changing the pricing. Simple. But no one communicated that. So this is one of the real problems where people put everything into a consolidated profit and loss account. The key drivers are very important because these are the key sub-accounts. The inventory of raw materials, the inventory of completed stock, debtors, creditors, research and development, capital expenditure. These type of items can get hidden in a budgetary process, I think sometimes deliberately, but I like having a very open presentation, because you've then got the information to confirm to each month. If the estimate of inventory raw materials was the investment was going to be $200,000 at the end of each month, and you notice it's growing up to $320,000, now there may be a good reason. the management team may have decided, because they're importing these products from overseas and the shipping schedules are changing because of the wars getting fought, unfortunately, around the world, they've decided to increase their inventory holdings in Australia. But that would have meant that payments had to get made. The overseas suppliers aren't going to voluntarily allow you to increase your client to increase their inventory levels in Australia unless they get paid. So what's that doing to the cash flow forecast? A blowout in debtors. If you've budgeted that the debtors days outstanding are going to be, say, 35 days, and you notice after 3 months they've climbed up to 46 days, there's got to be a cash flow implication out of that. So it's making the leadership team really concentrate on the issues. And your role as the virtual chief financial officer is to be monitoring this and alerting your client that these are problem areas. If the capital expenditure budget was set at $150,000 for the year and after 3 months it's already over $200,000, that's a real warning signal that things are getting off the rails. And if you're the CFO, you've got to jump on those things. I was a CFO in a listed public company, and I can assure you that jumping on them did not make me very popular with some of my other leadership team colleagues, but that was the role. You had to make sure you were trying to keep everyone within the limits that had been established by the business plan. If any of you have got any questions on any of this, obviously we can't have phone calls coming in on a podcast. We're not set up that way, but send me an email, please, peter@essbiztools.com.au. So the budgets for each operation help clarity. Something doesn't add up, but I can't see it. So it'll help you identify these loss-making divisions and cost blowouts that might be occurring. And the concept of having those separate budget forecasts and then later on P&L accounts, it gives you more control, gives clients clarity, and it gives something back to that manager that's managing that particular operation. Here's your result. So the key drivers I've already mentioned, they allow you to monitor what's happening in a whole range of activities and see how they're comparing back to the original budget estimates. So then we get to the cash flow forecast. Now, this is the heartbeat of a healthy organisation because everything revolves around cash, doesn't it? This is where it's coming from and this is where it's getting paid. And if there's variations, it can hurt the business. And one of the key roles of a senior accountant or a chief financial officer is to monitor what's happening and making sure people work within the parameters. So some of the stories I've come across, and actually they were more than stories, I was involved because we were monitoring a particular business. We'd set parameters, we'd done the calculations, and we, based on previous experience with this particular client's suppliers, we had calculated average payment dates on key suppliers, which we kept separately as a separate creditors item, the key suppliers. Some of them were getting paid on a weekly or fortnightly basis, but others we were taking 5 weeks, and we budgeted that way and factored in 37 days as those key creditors are outstanding. And then suddenly we note that it's down. In fact, I think it was 29 days. And we said, what's going on? And we inquired, and there was a new lady paying the bills. And she didn't like bills lying around on her desk. The due dates were up, so she was paying them. So you need to make sure you've communicated the strategies within the budgets to the people who were involved, the team. Don't go in a rouse at them. That lady thought she was doing a great job. And she just wanted to get rid of the invoices, etc., off her desk or out of her computer and pay them. But unfortunately, that blew out the cash flow. Not tremendously, but significantly enough for one of my team members, Eagle Eye, to pick it up and say, hey, look at this. And when we investigated, that's what had happened. But also the reversal can occur, of course, in debtors. And I've seen this happen too. You may have budgeted, you'll collect your debtors in 38 days, bit more than 30, but not up around 60. And suddenly you notice it's blowing out. Instead of 38 days, it's up around 49 days. And you say, what? And you find out that the lady that was looking after debtors has been off sick and no one really took over a job. No one was following through. The system that had been established that courtesy phone calls were made 3 or 4 days before the due date for a tax invoice were not being made. And people who had got used to these phone calls just presumably said, oh, well, no one's rang me. It mustn't be anything owing yet. And they weren't paying, and the debtors blow out. So the combination we had in that organisation was the creditors were lower than what we expected and the debtors were higher than what we expected. You can imagine what that's doing to the cash flow forecast. So this is the monitoring that needs to take place. And I think it's communication. It's a simple word, communication. You sit down and make sure those key people in the organisation, your client's organisation, they're the ones paying the bills and following up the debtors and stamping the due date for payment on the tax invoice. Run a training session with them. Talk to them. Take them into your confidence and show them how all this works. Show them, these are our estimates that have been utilised. For the last 3 or 4 or 5 years, our debtors have been paying us on a 37-day basis. So we think it's reasonable that we can expect that, but we don't want it to blow out to 45 days. We want to keep it on 37 days. And this is how we calculate it. And we're calculating this at least every month. Talk to them about the creditors. We're not cheating. We're not doing things. The creditors have allowed us to go to these payment terms. They're not objecting. They're not ringing us. But we don't want to suddenly start paying them out quicker, because that means it's taking up cash out of the business. And the inventory stockpiling can happen. Now, I know it's important that in some businesses there's stockpiles at certain times of the year. Right now is one of them. That stockpiling probably started 4 or 5 weeks ago, where stock was building up. And now some of your clients would have arranged with their suppliers not to make payments until March, April next year. I used to have a client who was a very big jewellery store operator, and he used to negotiate with major European manufacturers not to pay them until around the end of June next year, which was great for his cash flow. That's up to your client to negotiate. It's not your role, normally, but it is just part of this management of cash flow that's very important. And some of the items I've just talked to run into the next item I had in my notes, and that is cash flow can get out of whack even though when the business is trading profitably, because the profit and loss account basically assumes everything's getting paid. And if there's a blowout in debtors, for argument's sake, and inventory, the profit's been used up there. So the business can be running short of cash, even though its bottom line profitability might be very healthy. And we ran a webinar and a podcast a few weeks ago on that very issue. Balance sheets also tell a story, because this is, in the projections, this is what the business is going to look like in 12 months, 24 months, 36 months' time. It allows you to be the storyteller. So the presentation can be, this journey started with the business plan. We went through and we've analysed every aspect of your business. And then we brought back to you a draft of a business plan, and we then spent another hour or so going through it. And we made a couple of changes, and then we brought back the final document. And I invited you all to sign, the leadership team, to sign the document as the document. And out of all that now, this is what we predict that the balance sheet of this business is going to look like in 1, 2, and 3 years' time. It enables you to be the storyteller, to tell them that. But then you need to emphasize, but this is subject to the debtors' days outstanding being no more than 37 days. The creditors' days outstanding being 35 days. The inventory's not getting above certain levels. The productivity percentage, if you're in a tradie type organisation or a professional service organisation, you can spell those figures out. So the client leadership team really understand the parameters. And then each month you're going to give them feedback on that. Debtors have blown out to 40 days. Creditors have dropped down a bit, and we're now finding that they're sitting on 30 days because someone got excited and started to make all the payments earlier than what we had envisaged. Capital expenditure is one of the real problem areas. I've had clients say to me, oh, no, it's only going to cost $100,000. Well, how do you know that? Oh, I think that. Have you got a quote? Oh, no, we haven't got the quote yet. And then you find it's going to cost nearly $400,000. Well, where does that money come from? Client got it in their secret funding, or do they need to be able to go and raise money to cover that? So that's the preliminary overview of what this story is, what it's telling us as we look at the business. The key item then is that on a monthly basis, you're going to analyse all of this and compare it to the actual financial accounts and calculate the variations that can occur so that the leadership team have got real information to work with on an ongoing basis. This is the big problem with SMEs in Australia. And I probably would say probably the rest of the world. But we're only worried about Australia. That's our responsibility as Australian accountants to help our clients. So please think about it. Isn't this what we should be doing? The annual set of accounts and a tax return, or even quarterly accounts, unless they include key performance indicators, business metrics, this proper detailed analysis, don't help the client run their business. I'm convinced that the way that SMEs should be run is basically the same as the big end of town, who concentrate on daily, weekly, and then monthly information, and then they do it again the next month. It's very important. It's the way things operate. So that if there is a problem, or if there's something that doesn't meet their budget targets, their expectations, there can be a review undertaken immediately, not in 12 months' time, but now, to fix the problem now. It might be part of the culture that happens when you're part of a public company, which I was, that you've got the continuous disclosure requirements to the stock exchange. And this starts at the board of directors level, especially the external directors I found when I was the company secretary. They really want to know that the leadership team, management team, is looking at these things as they occur, daily, weekly, and fixing them. Because otherwise, if there's some big problem, there may have to be a report submitted to the stock exchange. Now, I suggest to you that one of the key roles for accountants is to think those things through, and you're not going to go and report to anyone other than the client and the directors, if you have directors. But it's this, well, we got to fix it. Something went wrong last week and we have to fix it. Because if we got an expectation of a gross profit percentage of 38% in an activity and we only got 23%, something went wrong. And the quicker we find out what that was, the better it will be, because it may continue. It may be an internal mathematical mistake or a human error mistake, and it just rolls on and on and on. And then what happens is finally someone prepares an annual set of accounts, and then it might be you, and you sit down and talk to your client and say, well, geez, gross profit was down a bit this year. Last year you've been running at 36 to 39%, and this year you're down around 24%. And that could have been that original problem has gone right through because no one picked it up. Because are your clients looking at their gross profit percentages each week? My observation of SMEs, most of them are not, because they don't know what they are. They don't know how to calculate them. But more importantly, they haven't got an accountant sitting in their organisation that's preparing that information, because owners tend to want to see it being prepared by someone who is responsible for the facts of that matter. It's just not someone that they suddenly pull in and say, well, you calculate all this for us. They haven't got the confidence that the answer they get's right. So if you come up and say we only made, so that person, that temporary person, let me call it that, says, oh, we only made 23% and the results are so and so. In a lot of cases, it does not get believed, because, that person probably doesn't know what he's talking about type attitude. Well, that's the wrong way, of course, to answer this. But what you bring as the accountant, acting as the virtual CFO, is a very important word called credibility. Credibility to the client, and to say, we are now going to go and investigate this. And that could even be something that's a separate item in your fee arrangement. That's up to you to sort out. But it should be immediately investigated. Then a report goes back to the client so they understand what the benefit of that review was. Oh, you found out such and such, and you could put into it. Now, if that had continued with no controls on it for the whole 12 months, what was it going to cost the client? If those figures I gave you were right, 38 to 23%, that 15% variation over a year would cost a lot of money. And your client could have been in some difficulties. And when you look at what the Ombudsman's talking about, the problems of small businesses in Australia, I know they're not all linked to these type of issues. I know some people run their businesses a wee bit differently. But there's a significant number, because the figures from the Ombudsman say over 1 million businesses are trading very poorly. I suggest a significant number of those people need a lot more assistance. And so do probably a lot more of the ones that are just struggling to get over the line, slightly above the average wage type returns. They need your assistance. And in this role, you can deliver it. One of the other issues we discuss in this newsletter is benchmarking. Now, benchmarking, I've had a lot to do with benchmarking over the years, ever since the Financial Management Research Centre, which was originally at the University of New England in Armidale, introduced a benchmarking service. They were the first ones in Australia to introduce it. And I worked closely with them over the years, FMRC benchmarking. But now we have an affiliation with Tax Fitness, who run a great benchmarking operation. And what they do is that they analyse types of businesses and then secure the information from various reports, 10 or 12 different areas. They get the information which allows them to identify how the top 20% of that industry category are performing. And that's what the comparison is to, not the average. Average is average. Your clients want to be one of the stars. They want to be in the A-League. They want to be in the Premier League. They want to be in the NRL top grade or the top AFL grades. And to do that, they've got to be compared to that top 20%. In football terms, you really should only compare to the minor Premier last year and the two teams in the grand finals. That's the comparison if you're trying to build up a football team. It's the same in a business. And the Tax Fitness benchmarking reports enable that to be determined, so that you've got this information that you can utilise. And I've negotiated the special arrangement for you with Darren Gleeson, the Managing Director of Tax Fitness. If you subscribe through ESS BIZTOOLS to Tax Fitness, you'll get it for $200 per annum cheaper. So go onto our website, you can see the application through to Tax Fitness, and that will give you access to their wonderful benchmarking service, where your clients are being compared to the top 20% of their category. So you can sit down then and you've got more information. You can say to them, well, your gross profit percentage is worked out at 38%, but the top 20% is coming in at 47% or whatever. And the client will say, wow, how do I get that? Well, that's when you can be analysing, and Tax Fitness will give you information that they've gleaned from their benchmarking analysis to be able to help you offer that service to your clients, help them understand what the changes were. The change might be the individual performance of team members. The productivity percentage for a top-class tradesman that you've got might be 74%. I'm not saying this is the actual situation, of course, but the Tax Fitness benchmarking report might say the top 20 are achieving 84%. So what's causing that difference of 12%? If you've got a number of men or women working for you in your top category and you're getting a 12% difference in productivity, that's adding up to a lot of money over a 12-month period. Or it might be the charge-out rate that you're using. Now, within E&SS BIZTOOLS, we have what we understand are the best practice in Australia on calculating charge-out rates for tradies so that you have geared the charge-out rate to the expected productivity. You've nominated, or your clients nominated, what profitability they want, because that's built into the calculation. And then each month you should be analysing the performance, checking their hours that they've been able to charge for the individual categories, and investigating why there's been variances. And if there's variances, sit down with the leadership team of the client and say, well, we budgeted for this top-level group of tradies that they would achieve a productivity percentage of 84%, but they're only achieving 73%. Now, you can do the benchmarking comparison, you can sit down and talk, but at the end of the day, you've got to be realistic and say to the leadership team, well, we budgeted 84%, and that's what the charge-out rate's been built at to achieve your profitability. You're only getting 73%. You are not going to achieve your budget estimate, your profitability estimate, if you stay on 73%. And we can do one or two things. One, you really analyse the Tax Fitness reports and sit down and talk to this group of tradies and try to encourage them to achieve an 84% productivity figure every day. Or we adjust the charge-out rates. You'll have to charge more per hour for your team members if you're going to achieve your profitability targets. That's what all this is about, helping your clients. We don't believe you should just set a target for the year and sit back and say, we'll have a look at it at the end of the year and see how we went. That's not managing. That's not managing the way big business do. And there's no reason why SMEs cannot use the same approach. As I said at the beginning, utilising today's technology, software, and communications. So in the next edition of this commentary on the looking at a business that's scaling up, we're going to be looking at, it'll be the final session. And I hope to have Darren Gleeson with me. So we'll discuss all aspects of the Chief Financial Officer's report, what I envisage is involved, raising of capital, crowdsource funding, equity raising, early stage innovation company, Section 708 of the Corporations Act, or venture capital raising, and what the CFO is doing. And obviously, if you're dealing with raising capital, benchmarking is very important. So that's why I'm going to be inviting Darren to join me in that presentation. If you've got any questions or comments on any matter that I've discussed today, please send me an email, peter@essbiztools.com.au. Stay safe. Have a great day. Goodbye.